Appreciate everyone joining this evening. Thank you for joining us on our Entrepreneurship Through Acquisition webinar focused on structuring the deal. I'm Joe Cortese, co-president of the Chicago Booth Alumni Club and a principal and senior consultant with DeMeo Schneider and Associates here in Chicago. With me again this evening is Brian O'Connor, Adjunct Associate Professor of Entrepreneurship at Booth and founder and managing principal of NexGen Growth Partners. Brian, nice to see you again. Thanks for joining us. We also have a special guest with us again this evening, and I'll ask him to introduce himself in just a moment once we get through a few opening considerations. So this is our fifth webinar focused on ETA. We do have the links to the previous webinars available on the Chicago Booth Alumni Club of Chicago's website, so you can join there. Tim Stade, who's with us as well, has been kind enough to put the link in the chat box in previous sessions, so he may be able to do that as well this evening. As I mentioned, we will focus on structuring the deal this evening and how you actually complete the purchasing transaction of a small business. And we'll spend some time learning about the various types of deal structures, how the process plays out. We'll walk through a couple common pitfalls that torpedo deals and hopefully hear a little bit about some live examples as well. As we've done in previous sessions, we will take questions along the way. So if you would like to submit a question, please go ahead and do that via the question and answer box, and we'll deal with those as we go through the meeting here. We do welcome any and all questions. We'll do our best to get to all of them as we go. Also mention quickly, we will have another webinar focused on ETA in December. In this final one for 2020, we'll focus on the actual day in the life of an entrepreneur running a small private equity-backed company, and learn a little bit more about that. So with that, I'd like to turn to our special guest. Very pleased to have Josh Dennis with us here tonight. Thank you for joining, Josh. If you wouldn't mind, please give us a brief introduction and background on yourself, and then we'll dive into the content.
That sounds great. Well, I appreciate you having me on here. I've watched several episodes, so it's great to be here. Josh Dennis, I'm a principal at NextGen Growth Partners. Quick background, I started my career in investment banking and then middle market private equity, kind of a typical finance track before going to business school at Booth, where I graduated in 2016. And it was while I was at Booth that I learned about ETA, or the search fund model, as we called it. You know, everyone's familiar with the search fund model, but in 2000, I think it was early 2015, was the first year that they taught the ETA class, and Brian and Mark Agnew taught the class, and that's where I learned much more about it, became extremely interested, and also developed a relationship with Brian, Mark, and a lot of others in the ETA community. And from there, I came back for my second year, was trying to figure out if I wanted to raise a search fund or go back in the investing role. And that's when Brian told me about this idea he'd had. And it was a great fit or mix between kind of the benefits you get from a traditional private equity fund, committed capital. We can get into all of that, but also taking the benefits of the traditional search fund model. And I thought it made a ton of sense, and it was a perfect combination of my experience and interest in investing, but also in the intrigue and real opportunity that I saw in the search fund model. And so it was right then that I joined NextGen Growth Partners and have been here since 2016. And my role is really leading the investment team and working alongside our entrepreneurs and residents to help with the evaluation of opportunities or industry theses, and then the evaluation, structuring, and negotiating and deal execution to get to close. And then we'll work with portfolio companies kind of on an as-needed basis for M&A or other kind of strategic initiatives.
Fantastic, appreciate that. And I really appreciate you again being here with us this evening. Let's start at the top. Walk us through kind of the steps of the acquisition process from your seat and kind of the main points there, and then we'll dive into the details as we go along.
Yeah, so the first part of it is just sourcing. So how are we finding these opportunities? And we use two primary methods. I think everyone uses these primary two. It's Is the deal intermediated, meaning they have an investment banker or a business broker helping with the marketing and negotiating to try to find a high price and they're willing sellers? Or is it more proprietary? And that's when you reach out directly to a business owner. They're not necessarily looking to sell, or at least they're not hiring someone to help sell their business, but they're interested in what you have to say, and you start a conversation from that point of view. They're similar processes. I'll walk through the kind of typical banked process first. I mean, you start by receiving some information on the company and the industry. It's usually in the form of a SIM or a confidential information memorandum. You take a look at that, see if you're interested, and if you are, maybe have a follow-up call, request some data from the intermediary, and then submit an indication of interest, or an IOI. It's kind of a high-level evaluation range that is used to see if you're in the ballpark of the other potential buyers. Or if it's proprietary, it could be even verbal, but see if you're in the same ballpark as the seller and what they're expecting for this transaction. If that's somewhat in line, then you move on. And then typically you go meet them in person, continue to request data. That's a theme that kind of never stops throughout the process. And also build rapport and build the relationship with the seller. I think that's critical through this process. I mean, valuation, cash at close, structure is all very important, but a lot of that can be figured out if you have that rapport and foundation built with the seller throughout the entire process, and that trust starts to develop, and that can go a long way. So from there, you have enough to come to a pinpointed valuation structure. If the seller decides that that's acceptable, then you sign a letter of intent or an LOI and go into full due diligence. Happy to walk through those phases, but basically you are inspecting everything you can about the company itself, the team, the seller, the industry. You're doing legal diligence, financial diligence, and so the list goes on. But the full kind of inspection until you finally negotiate legal docs and get to close.
Got it. Great.
I think the one thing that I just sort of mentioned, Josh, and we've talked about, Joe, we've talked about some of this in prior sessions, but the diligence effort in an ETA transaction, looks a lot like it does in a traditional private equity buyout situation, but for the fact that these are small businesses and typically you're not operating out of a huge budget that is able to sustain what we at our firm and what in private equity sort of called dead deal cost, which is diligence fees and expenses that you might rack up in a quality of earnings engagement with an accounting service provider, or legal diligence fees with high-priced lawyers, or documentation fees that you might incur when you get further on. So there's this balance in ETA deal making around, what can you accomplish in diligence that is your own kind of blood, sweat, and tears, and just rolling up your sleeves and figuring out the industry and getting to the core economics of the business and how they make money and how they contract or not with their client base and so there's a tremendous amount of what we call at the firm business diligence that goes into these things pre-LOI and then post-LOI before you start engaging some of the third-party service providers that would be customary to engage post-LOI as you're working an opportunity toward the closing and funding table. We can talk a little bit about that. I mean, I think like search funds historically don't have a tremendous amount of operating budget to sustain those types of dead deal costs. A firm like NGP, we do have a little bit more, but at the same time, again, this is small part of the market. These aren't, billion-dollar transactions that can sustain, dead deal costs or extraneous expenses when ultimately you don't effectuate a transaction.
How do you factor in those dead deal costs? That's interesting. I didn't know a lot about that. Are you looking to kind of keep those to percentage of the transaction, the overall transaction size, or does that just factor into the, the model that you put together to complete the transaction? A little bit more information on that would be interesting.
Yeah, I'll let Josh talk about it a little bit, but we like 0% of the transaction. It can be detrimental to returns, right? And it can almost be catastrophic. I mean, in one of our earlier sessions, we talked about the 3 models that you can embark upon to pursue ETA. There's sort of the self-funded model, and I suppose that in the self-funded model, you can sustain shocks from dead deal costs to the extent that your bank account can support them, right? So that's sort of the self-funded. And then the search fund path, I would argue there's not a ton of room for dead deal expenses before you get to a position where you're short on budget to ultimately consummate a transaction. We talked about in that path, you're typically funded for a 2.5, maybe 3-year period. But that budget, can't sustain a tremendous amount of the way in the way of, billable hours from a high-priced attorney.
Sure.
So you got to be really careful about that. At our firm, again, we try to manage it down. I think it's an inevitability in any private equity model that you're going to spend time and ultimately money with third-party service providers on things that don't end up transacting. But, we, like any other private equity firm, try to keep those to a bare minimum because they are a drag on returns.
Yeah, and it helps to develop relationships with service attorneys or accountants and so on that you work with on multiple transactions. And so then when we do have a deal that falls apart after spending some money on diligence, they're a lot more willing to, do a discount and even defer until the next transaction closes. So those types of things help a lot. And I guess the last thing I would add is regardless of deal size, you still have to go through similar steps. It gets much more complex the larger the company and all of the systems and team and all of that. But we still have to dig in almost as much as we would if we're doing a $10 million deal as we would a $100 million deal. And so the costs of the service providers scale down as you go down market to an extent, but they still do cost money, and it's something we're conscious of for sure.
Yeah, and I know we talked about this a little bit in the past, but just to orient folks, we got a question from Nathan that asks, what's the typical deal size for ETA? And maybe we'll stick to kind of what you guys are looking for in terms of the typical sizes, just to give some folks the perspective that we're talking about here.
Yeah, it tends to be, call it 10 to 50 million in enterprise value. So the typical transaction that I talk about in a search fund setting is like a $2 million EBITDA business bought at 5 or 6 times trailing 12 months EBITDA. So $10 to $12 million in enterprise value. You're probably going to have some third-party debt or some seller financing as part of that capital structure to the tune of maybe half of the capital structure. So call it somewhere in the neighborhood of $5 to $6 million in equity, I think is sort of a good zone to think about in a search fund setting. Self-funded transactions on average, there are some larger, some smaller than that, but they tend to be slightly smaller. At our firm, they tend to be a little bit bigger than that. Maybe 4 million in EBITDA bought at somewhere in the neighborhood of 4.5 or 5 times, getting you to a higher enterprise value. But that's sort of the zone that we're talking about, $10 to $50 million in annual in enterprise value.
That's great. A couple of other interesting questions here. Ramiro asks, what are the core activities that a funded searcher should really do themselves prior to or in parallel to hiring third-party providers? Or said differently, what do you guys look to do yourselves, your firm? What does your firm look to do within your firm? And then what are you typically looking to outsource?
Yeah, so at a high level, we do as much as we can internally. And myself, the the rest of our investment team, my colleague Parker, as well as the entrepreneur in residence, are digging in to the data that we receive immediately and continuing to do so until we have a level of comfort that it shouldn't be very far off. And I'm talking financial diligence right now. EBITDA or revenue, there shouldn't be any huge differences with what the Q of E providers will find. And what that means is a lot of customer data analysis, really understanding the trends, what is driving the growth of the business and how much concentration is there, and then kind of levels and levels deeper. And putting that together in kind of a package, and then we'll go to the rest of the group and our investment committee to discuss some of the findings. But all of that's done, and I would say that it's quite a bit of work up front before we decide to, usually the first step is to hire a quality of earnings provider. And so I think we do a lot of the work internally to avoid those dead deal costs that we were talking about.
And Joe, as I think we've talked about in a previous session, you know, it's generally not the case that you're looking at a business that has, you know, an annual audit done. I mean,
Right.
these are businesses that, you know, you're kind of lucky if their financials are housed within a system as, you know, as pretty bare bones as like a QuickBooks kind of thing. I mean, it's not uncommon that Josh and the investments team gets, you know, a neatly stacked pile of napkins that, you know, contain historical financial statements. It's like, you know, there is a tremendous amount of work that you all as Booth MBAs, given your training and your experience, can do. But there definitely is some third-party work that needs to get done to validate, you know, the work that you've done and the data and the information that's been shared with you from the sellers. You certainly hope that no one is being deceitful in the information that they're sharing with you. But, you know, trust but verify. And you need to, often you'll need at some point later in the diligence process, a third-party expert to do some of that.
Yeah, seems to be a popular topic with the audience here. We're getting a few more questions. This is an interesting one from Dave. Do you often see self-funded searchers dealing with service providers on a contingent basis in order to offset the risk? Or is that something that takes place from time to time in the industry, or from your perspective?
Yeah, it happens. I would say there are certain service providers that are willing to work on a contingent basis. I think that Josh alluded to some of this earlier. You know, some of them are willing to not forego expenses in the event that a deal doesn't close, but potentially defer them and roll them into a transaction that does get consummated if they have a high level of belief that that entrepreneur, self-funded or otherwise, is at some point going to consummate a transaction. So you might have some flexibility for deferral of some of that. Josh, I don't know if you have a perspective, but you know, I think it's tricky. You'll find some that are willing to, you know, work a little bit on a contingent basis, but it's typically more sort of discount and deferral of incurred expenses as opposed to a complete sort of like, I will only, you know, send you a bill for my services in the event that you consummate a transaction.
Yeah, I totally agree. Some will defer until it closes and charge a little bit if nothing closes, but full contingency is, I haven't seen it, but maybe it's out there.
Yeah, I was thinking as you were speaking, maybe it's a little bit of adverse selection too, right? Like those folks that would that would operate on a contingent basis may not be the folks you necessarily want to hire, right?
And Joe, I sort of had that adverse selection thought come through my mind as I was talking about it too.
Yeah.
So yeah, there may be some of that, but I know it does exist. It's worth exploring because service providers that do serve this kind of small part of the market understand and appreciate the constraints associated with a search funder or a self-funded searcher's limited budget.
Yeah, that's an important point. Maybe something to note is ask them how familiar they are with this type of model before going into any type of agreement. And there are some high quality service providers that are maybe starting a new firm on their own with a smaller team and looking to build that list of clients. And maybe that's an opportunity to get a fully contingent type of agreement in place, but you just got to be careful.
Good point. Josh, talk a little bit about just the negotiation process as you're getting the deal started. I mean, how contentious is it? I know it's different for every transaction, but just some general sense of, you know, how contentious is it? How much kind of back and forth goes on before you kind of get the bones of the deal in place and then can move forward? And what do you do if it gets contentious, those sorts of things? I'd be interested in your experience there along those lines.
Yeah, no, it's a really important topic. I think the first point of contention can be when you're negotiating the letter of intent. And so that's really when you're getting engaged and preparing to get married. And so that engagement, I mean, that's where it leads to a lot of dead deals if you just can't bridge gaps. I think where the real contention comes into play is during diligence. You're constantly asking for data or follow-up questions. You're harassing the seller, maybe their team if they've let anyone kind of in the circle. You have all of these service providers that are also kind of bugging them, and they're trying to run their business. And so it can be overwhelming pretty quickly. And that leads to a lot of deal fatigue and just exhaustion for the seller, and it's completely understandable. It's also exhausting for the buyer. And so what happens when a lot of fatigue comes into play, people start to get on edge. You start to forget why you signed that LOI in the first place. And so I think there's a few things that are important to do up front and then throughout the process. The first is, as soon as that LOI is signed, set expectations with the seller on exactly what your plan for the process is, what you expect the data request list to look like comprehensively. There's a balance. You may not want to send every single thing, but showing them like, this is going to be a tough process, and just getting out in front of that. And that way you can point back to it and they're not caught off guard, or at least they shouldn't be. And then throughout the process, trying to remember why you're so excited about this opportunity and why the seller should be excited about you, and focusing on the relationship building and having sometimes a kind of a good cop, bad cop mentality can be helpful, especially with the person kind of leading the deal. If it's a searcher or an EIR, you know, typically they're going to be working day in and day out with the seller post-close and their team. And so it's not fun when you finally close a deal and then the next day you're working together, but there's a lot of resentment left over. So we try to let the EIR focus on that part. We try to be the annoying people, and also don't be afraid to blame your service providers.
That's a good little point at the end there, Josh. Don't be afraid to blame the service providers. You know, the notion of good cop, bad cop is an interesting one. And you know, listen, whatever path you choose for ETA, I think there will be points in time where there needs to be some of that dynamic. And often you can use your investors. You can use Brian or Josh or a service provider as a bad cop, because one of the things that Josh mentioned that's just critically important is that, you know, you're building a relationship. Remember, in one of the prior sessions, or probably many of them, we talked about that it's highly unlikely that you're going to be the highest bidder in a very competitively run auction process. And so we tend to avoid those types of situations, but you know, in all likelihood, the seller is choosing you as the buyer for some reasons that are non-economic, right? And those are probably relational. They like you, they think you're going to do well by their employees, their customers, all stakeholders of the business post-transaction. And therefore, it's critically important during these contentious situations, and every deal has many of them. And Josh pointed out a couple of points in the process that are typically more likely to be contentious than others. But it's critically important that you rely on the relationship and the trust and the goodwill that you've built early on in sort of the stages leading up to LOI or around LOI execution, because there will be very tough days and very tough conversations in the engagement period, as Josh sort of put it, that you're going to have to draw on some of that goodwill, trust, and relationship that you've built with the seller. Again, with the analogy during the courtship process, that's super important.
Couple more questions here. Would you recommend that the searcher send out the first draft of the purchase agreement, or do you want the other side to kind of submit their offer first, their information first?
That could be a quick one for me. You want the power of the pen.
Yeah.
You want to control the draft of the purchase agreement.
Yeah.
I'm having a hard time thinking of a situation where there'd be an exception to that. But I as the buyer, as the searcher, I want to control the purchase agreement.
Anything to add there, Josh?
No, I mean, yes, you definitely want to do that.
Great. Let's focus a little bit on structure. Can you talk through just some of the structures that you've seen thus far? Again, I know there's a lot of optionality here, but some of the things that you've seen work that have worked better, some of the things that haven't worked as well, and some more information there I think would be useful.
Yeah, so I think in a typical private equity transaction, and larger is what I mean by that, it's usually kind of cash at close, and there's equity and there's debt, and that can be split up a bunch of different ways. I think as you go further down market, and a lot of what we're doing with the proprietary sourcing model that we have is we're talking with sellers that may have a number in their mind, but maybe you could get there if they grow a ton, or if you can mitigate risk in other ways. And so ways to bridge the gap in valuation expectations versus what you may be willing to pay at close is like an earnout. And so what that means is you work with the seller, and first you kind of get an understanding of what they expect growth to look like in the next 1 year, 2 years, 3 years, and so on. And then you kind of say, okay, well, I agree. If you can hit those targets, we will pay you X amount more to bridge that gap. We'll pay you 10 million at close, and then we'll pay you another 4 million over the course of 3 years. I'm making numbers up, but that's a tool that we use quite a bit. There are some downsides to it that I'd be happy to get into, but quickly, I think other useful tools, rollover equity from the seller, it's very common, and it helps just align incentives. And I think that's what everything comes down to, aligning incentives post-close. And so rollover equity is huge. Another way is a seller note. So they would fund a piece of debt at close, and you would pay some interest on it, but it can be really attractive because it's typically, there's no covenants. It's usually a lower interest rate, and you're working with the seller directly instead of some like a senior bank or something to that effect.
Yeah, two quick, I agree with everything that Josh said. Two quick points, maybe at one layer deeper. It's often the case that because you've built such a relationship with the business owner, operator, perhaps the founder, they get excited about the vision that you have for taking their business to the next level. And so the notion that they can roll equity and take a second bite at the apple, and getting them excited about the future value of that equity, to Josh's point, aligns interests really well. And if they've got sort of this number in mind however they arrived at that number might be completely irrational, but it may help bridge a gap if they sort of say, oh boy, well, if I have continued equity interest in this business and I can take a second bite at the apple, that's really interesting. And I can sort of, remain somewhat involved in the business kind of on a go forward basis. So that's a really interesting and powerful tool. It does have the ability to bridge a gap. It does have the ability to align interest pretty nicely. One thing I'd say on earnouts, and you do see them in the part of the market that we're sort of talking about in this series, they often become contentious. The best earnout is the one that gets paid, because that means that it's the business is growing and it's performing and it's hitting all the targets, and frankly, at that point, you're happy to pay the earnout, and the seller is happy to receive that earnout. Where a business is faltering and an earnout comes into question, whether or not it should or shouldn't be paid, it can get litigious, it can get combative, it presents other unique operational challenges. If the seller remains involved operationally in the business, then you have a situation where you've got someone that is doing something for the business and presumably creating value, that you have an issue with the economics and the payments and the capital structure that can create a really tough dynamic. And I've seen that go the wrong way. So you got to be careful with the way that you use some of these tools, specifically the earnout tool. But to Josh's point, they can absolutely be powerful in bridging a difference in valuation expectations between buyer and seller.
This notion of earnout. I'm sorry, Josh, did you want to add something, please?
Oh, I like kind of getting more into the weeds. I think that can be more valuable. And once we talked about, if they hit it, it's great, cool. If they don't, then it could get really contentious. I think another really difficult situation is when it's very close to the target number and you have to decide, do you want to pay it anyway or not, even though maybe by the letter of the law you don't need to, and how does that affect the relationship? And also, what is the target based on? Is it revenue, or is it all the way down to some adjusted EBITDA number? And as the investor or the buyer, it's easy to say you'd prefer the lower on the P&L, because that you want profitable revenue. You don't just want any top line growth.
Sure.
But it creates a lot more complexity, especially if you're hiring a team or investing in some type of infrastructure technology, and that all goes to OpEx. Well, how is that calculated in the adjusted EBITDA you're talking about now that you're in control? And so I think if you do want to use an earnout, it's just important to define everything extremely clearly and as explicitly as possible in the legal docs, so that you can point back to it and there's no real questions. They look great on paper, but it gets really tough when you're trying to define those things.
Sure. This notion of earnouts is garnering a lot of questions here. Just to clarify, can you have an earnout situation where the seller is no longer involved in the business?
Absolutely. To Josh's point, a seller might raise their hand and say, well, listen, if I'm not operationally involved in the business anymore and you're making decisions that are impacting my ability to achieve that future earnout payment, a la a decision to make an investment into a new division, or build out a sales, marketing, and BD function that has a immediate term P&L negative impact, an EBITDA margin compressing event for future earnings growth, that has a real implication for a seller that during that immediate term period is reliant on nominal earnings growth to achieve their earnout targets. So you get into a situation where a savvy seller sort of says, well, this doesn't feel right that I have an earnout tied to something that I don't have operational control over anymore, which again, it's all a negotiation, right? So,
Yeah.
and when you do have a seller that's critically important to the ongoing operation of the business, and you arrive in a situation where, to Josh's point, it's close, or the earnout is technically not to be paid or to be paid in full, but a portion of your revenue generation of that business is dependent on them getting excited and being happy about coming into work every day. Well, that can be so. Again, these things, they're tricky. The devil is in the details on these things. And but the short answer to the question is yes, you can have an earnout situation where a seller is not operationally involved, if the seller is willing to agree to that.
And what do you see in terms of typical equity rollover percentage? Is there something you guys target or shoot for, or is there some sort of just a guideline that's helpful to make sure that somebody's incentivized? What's your experience there?
As a general ballpark number, if I had to pick one, roughly 20%. I'd say 10 to 20% is enough incentive, along with, and these are typically founder owners, not always, but along with the personal investment they've already made and the attachment they have to the company when they sell. Keeping at least 10%, I think, is important to us usually. But that said, it's not always the case. We've been able to close on transactions where the founder legitimately wanted to stop running the business after a transition period and hang out with his family and just not worry about the business. And so we can make that happen. But in those situations, you really have to dig in and get to know the seller and really develop that trust to make sure they're not, trying to pull one over on you in some way.
Yeah, I mean, I think it goes back to something we've talked about in the prior session, but there's always asymmetric information. The seller always knows more about his or her business than you do as the buyer. And therefore, if there's an unwillingness to roll equity or carry some paper or participate in an earnout, that may be okay. You really got to understand if they're selling you a bill of goods that you're not fully aware of, kind of what it is that you're buying. Now, just a real quick point on at our firm, and I think in ETA broadly, these are typically change of control transactions. So the range that Josh shared with you, I think is right on. That's sort of the way we think about it. You wouldn't likely get into a scenario, or I haven't seen many, I can't really think of any off the top of my head, where a seller is rolling equity and maintaining a control equity position in the business. That feels like a sort of a growth equity type situation, where there's a minority investor and the searcher coming in. I'm sure there are unique structures that exist that where you might sort of think about doing that, but typically it would not be that the seller would maintain a majority equity position in the business post-transaction.
Let's transition over and talk about some of the pitfalls that you tend to see. I'm interested to hear in your experience. Maybe you've got a couple live or examples you could talk through about. You've started the process and then for whatever reason it's fallen apart. I'd love to hear more about some of the things that can typically torpedo a deal.
Oh man, where do we start?
I'm sure there's a lot there.
I'll start kind of high level, and then I'm happy to talk as much as you guys want about specific examples. But can we just go with post LOI? I think before then it's
sure.
Kind of too early. So I think one is something I mentioned, but it's deal fatigue and resentment starting to build on both sides, and a lack of clear communication that it makes the relationship that used to be in a good spot in such a bad spot that both sides are ready to kind of toss in the towel. A couple more specific examples though would be legal documentation. So these legal docs are not simple. A purchase agreement 90, 100 pages, whatever it is. And it's not in plain English. And especially for someone that's not an attorney, or maybe they have hired their friend that's an attorney, but not necessarily experienced in M&A, that can lead to some real confusion and like, why are you speaking in this crazy language? Why can't we just do a handshake deal or have it like on a one-page agreement? That has caused contention in the past. We've had to try to explain it and work through it, but that can be a shocker to a lot of sellers. And on the notion of the service providers that the seller hires, whether that's an attorney or some other kind of advisor, it depends on how experienced they are and how well they know the typical process or what to expect, and then help communicate to the seller if this is kind of normal, or if they start saying things that are normal course are way kind of overboard or out of line and so on, it kind of poisons the well to an extent with the seller, and then they start to mistrust you. And so, again, happy to dig into any of those things, but those are a few topics that come to mind.
Yeah, I mean, and Josh, I think that's right on. I think that we could go on and on, honestly, Joe, for like hours on sort of the ways that these things can fall apart. I mean, I'll give you one sort of nuanced example, but you know, and it's sort of in line, I think, with like this technical purchase agreement that can be very intimidating and feel like, oh my gosh, this searcher or this buyer is trying to pull the wool over my eyes, sort of thing. I mean, things that maybe as second nature to Booth alum as like networking capital, like you're establishing when you buy one of these businesses, you're buying it on a cash-free, debt-free basis, but it needs to be delivered with a certain level of working capital to be able to perform, right? The analogy that I use is like when you buy a car, you can't drive it off the lot without at least a workable level of oil and fuel in the gas tank.
Right.
And so working capital tends to be sort of like the oil and the fuel of the car. And so, you know, we got into a situation where we were like getting really close on a deal, and it came time to negotiate the working capital peg. And the seller just had a fundamental sort of disagreement about, you know, he thought that receivables, you know, were his, and I can't even remember if the situation was like that he wanted to leave the payables or what it was, or that all payables would be exhausted and then the receivables were his at time of close. But it's like, and that was like I think, Josh, correct me if I'm wrong, I don't know if you even know the example that I'm referring to, but I think it was like a $2 million networking capital, you know, type of need for this business. And, you know, you may take some of these things for granted, but a business owner, an operator who's built a really great business might not necessarily think about some of these nuanced components of deal making that are pretty customary. That, you know, when you buy a small privately held business, that it does need to be delivered with a, you know, a normalized and agreeable level of networking capital.
Sure.
Yeah, and it's understandable. And I'm glad you brought that up. This is a topic that comes up a lot and comes back to setting expectations up front. I think it can be helpful even pre-LOI, just because the words in the LOI say a normalized amount of working capital left on the balance sheet at close, or whatever the language is. That doesn't necessarily mean you're on the same page with the seller. So explaining to them how it works, because it's like, well, I generated that revenue. Why? Of course, I'm going to keep the cash that comes in after that revenue is generated. And so there's other examples like that I think, again, comes back to just being clear up front and making sure you don't miss these big things.
What's sort of I know this, again, general question, but just a sense, you know, you decide to you found a business that you want to purchase, from sort of like when that process begins to when you can actually consummate the deal and sign the docs and the transaction's complete, what are some ranges of time that it takes to do that?
Anywhere from, and I'm sorry, from when you initiate the conversation or when you sign the LOI?
Let's say, yeah, not including all of that, because again, that can vary widely as well. But when you said, okay, we're gonna do this deal, maybe you've agreed to the terms of an LOI or something, and so the real sort of transaction process begins.
I typically 75 days on average. If I had to pick a number, I think 60 to 90 is kind of the general range we provide. But with that said, if there is some need to close extremely quickly and the seller and their advisors are providing data and very responsive and so on, we can close a deal in 30 to 45 days if that was on the line and everyone was working hard. And then there's also times where it's the opposite and it drags on to 120 plus days. So yeah, I'll stop there.
On that topic, I think it's, you're typically negotiating a letter of intent that stipulates an exclusivity period that should be in line with the amount of time that you expect. Hopefully you can negotiate as the buyer a little bit of buffer, a little bit of wiggle room. So if you think you can close the deal in 60 days, you might try to negotiate a 90-day exclusivity period to work in earnest to get the deal consummated. But I think Josh's ranges are spot on. The pre-LOI stuff, and I know we're not focusing on that, Matt, Joe, can vary widely. I mean, that's anywhere from a couple days to several years, right? We've been working opportunities for years and years and years, and hopes that someday we get them to the finish line. But that varies extremely widely. But post LOI, that's a pretty good kind of general sense.
So, and kind of along those lines, we're living in a COVID world these days, and hopefully there's some light at the end of the tunnel, but it seems like we've got a ways to go here. How has the COVID environment impacted getting deals done? Has it changed timelines, lengthened them? And what impacts have you seen as a result of dealing with COVID?
Yeah, it's been challenging, and there were some sellers and companies that we were negotiating with, or like getting closer or further down the process, and COVID hit, and like a lot of businesses, they took a drop, especially in Q2 of this year. And so then, just because maybe their earnings or the revenue were declining among this economic environment, that doesn't mean that the number they had in their head for the valuation of their business changed at all. But as the investor or as the buyer, it was really hard, and it still is, frankly, to know if this is like a trough and it's about to bounce back, or if this is a longer term kind of more sustainable trend in the business. And therefore, well, I guess in either case, that does change the valuation, at least the structure from our perspective. And that led to, okay, let's put it on hold. Let's keep in touch and see kind of how this plays out. But that's been a difficult challenge with some deals that were already in the hopper. And then now in Q4, we're seeing volume pick back up as people have a little bit more visibility into the next year and kind of their customers and P&L and all of that. But you still have that question, and there's still uncertainty of what happens in the next 3, 6, 12 months, for sure. So with all that said, I think there's a couple of points. One, we've continued to reach out and try to use this as a way to add value, if possible, to business owners that are trying to navigate this difficult time, like a lot of other business owners, like we are at NexGen and pretty much everyone in the world. So how can we be a value-added partner to them during this time and build that rapport that we've talked about? And when the time does become right, then we are in a good spot. And I guess the second thing is the businesses that we've seen that had some kind of tailwind from COVID, and I mean, picture a manufacturer of masks or something like that. We've seen premiums on those types of businesses because there are a lot of buyers out there. There's a lot of dry powder, and people are bidding out for companies that are growing and maybe accelerating growth during this time.
The good news is, for all the uncertainty that COVID has brought, at least our political landscape in the U.S. has got a lot of clarity on it right now. So that's been a counterbalance. So no, I think that's right. It's uncertain. Buyers and sellers are uncertain. It's harder to form relationships. Like normally, Joe, you and I would be doing this in person, and we'd invite people. It's just, top of the funnel stuff, pre-LOI, building the relationships that are required to get you to LOI execution, and again, build that trust and goodwill that is going to be needed to take you through the deal process. It's just harder to do in this environment. We're figuring out new ways to do it, but it's challenging. Josh focused on a lot of the kind of post LOI and how is the company performing amid all that's going on. And the other component to it, right, is there's a big piece of this that's about building trust and building relationships and fostering those relationships. And I think that's been certainly more challenging in this environment that we're all living in than it was in November of last year, where it would have been easier for us to hop on a plane and take a meeting in Omaha, Nebraska with a business owner that was inclined to engage with us. It's, how do you do that in a way that makes everybody comfortable? And is it Zoom, or, how do you, so there have been definite implications across the whole timeline and spectrum of activities.
And a question specific to that is, how has the ability to obtain external financing been impacted, bank debt and otherwise? I mean, are those spigots starting to come open again? Are some of the government programs that have been enacted available to use here at all? And how does that look in the current environment?
Yeah, the government programs have been options that we've considered and looked into, and that's definitely helpful. From a senior banking, like a senior bank lender perspective, they are typically, not always at all, but typically a little bit more conservative, and the lack of visibility and uncertainty in this environment has led them to be a little bit more particular, or maybe a little bit more conservative in terms of covenants and things like that. But really, in our transactions, we typically like to use very flexible debt options. And so it may be a little bit more expensive on a cash interest basis, but with that comes, no amortization, for example. So we can preserve that cash flow, very much looser covenants, and that helps a lot. And from those lenders, we've seen a continued desire to deploy capital at similar terms that we were seeing prior to the COVID environment.
Yeah, there's a white paper that my teaching partner and I, Mark Agnew, and I collaborated with our friend at the Yale School of Management that teaches a similar course to the one that we do at Booth, and the white paper is called "On the Nature of Debt," and it gets into some of the nuances of debt, not necessarily amid COVID, but around the cost of that paper vis-a-vis all of the other considerations that we would argue are equally, if not more important, when evaluating what type of debt, how much, and how to use it in your capital structure. So I'd encourage people to check out the piece called "On the Nature of Debt" if you're interested in this type of stuff.
Thank you for that. Appreciate it. Just looking at a few more questions here. Can you talk a little bit about, we've got a couple more minutes here. Can you talk a little bit about escrow accounts and purchase price holdbacks, and sort of, are there typical guidelines there and structures that you're looking for? How do you think about that and incorporate that into the transaction?
Yeah, another thing to talk about up front with the seller, like at LOI stage, because that can be a shock if 5 to 10% of the purchase price is held back in an escrow account. And I think that's a good general range, roughly 8%, 5 to 10. And typically that's released after 12 months, maybe half at 12 months, half at 18 or 24 months. And as long as basically everything checks out. You didn't find any fraudulent activity or things in the reps and warranties. With all of that said, we've started to see a lot more providers of reps and warranties insurance at lower in the market, meaning a lower transaction value. This has become almost standard, extremely common when you get to very large deals. But what it does is you find an insurance provider and the escrow goes from 10% of the purchase price to 150,000. So the seller has some skin in the game, but then they cover any damages from breaches of reps and warranties. And so that gives the seller a lot more cash at close, and you don't have to worry as much about dealing with those dynamics. Do you draw it from the escrow or not? If something technically happens, there's a lot of kind of nuanced things that can happen that cause complications. But I would say R&W insurance is something to look into, even at sub 10 million transaction value.
And along those lines, do you typically see breakup fees in this area of the market? Is that something that you guys have used in the past, or?
No, and just to clarify by that, you mean if we walk away for whatever reason, do we owe a fee?
Yes.
Or vice versa? Yeah, no, we don't come across that. And if we do, we wouldn't agree to it right now or at all.
Got it. That's helpful. Well, we're coming up on the top of the hour here. I really appreciate this. We've got a few questions that we didn't get to, but most of which we've dealt with in previous sessions. So if you did ask a question that we didn't answer live in the meeting this evening, I'd encourage you to go to the Chicago Booth Alumni Chicago webpage and check out the previous webinars that we posted. Most of the questions that we didn't get to tonight have been answered there. But really appreciate everyone joining this evening. We got a lot of great questions, so thank you all for the questions that we did receive tonight. Certainly want to thank Brian. Really appreciate you joining us again, and Josh, it was really great having you on the meeting tonight. Really appreciate your participation here. And as I said, we will have another installment in December where we'll talk with one of the folks living the entrepreneur in residence ETA life and practice, and working with one of the companies on a daily basis. So we'll look forward to that. Again, thank you all very much. Brian, Josh, thank you, and hope everyone has a wonderful evening.
Thank you.
Joe. Thanks, everybody.
Take care.
Bye.